Hi, welcome to your next market update. Today we're going to be focusing on the S&P and crude oil. The main focus will be the S&P because the S&P has made new highs for the move. And let's go through. We're going to be looking at a daily chart, a weekly chart, and then a monthly chart on the cash S&P. So what I want to show here, happens to be an oscillator RSI, and I just wanted to show you this oscillator because what happens is what's nice about the rally over the past couple of months in the S&P is the market moves up and then trades sideways. And notice when it trades sideways, it helps relieve the overbought condition. So it moves up a little bit more, it trades laterally, the overbought condition gets back to more sustainable levels, and actually got a lot of the overbought condition actually got into oversold territory last week, as we see here. Now, just a kind of a heads up, although our niche is candlesticks, since we revealed them to the Western world, we also focus a lot on Western technicals in our more advanced sessions. And for those who trade with oscillators, keep in mind when you have a very strongly trending market, the oscillator, whether it's RSI or stochastics or whatever, can get into overbought territory and just stay that way. Oscillators really work best in lateral trading environments, which we really have not been, and we've been trading pretty much in a nice, strong uptrend. But the reason I wanted to show you this particular oscillator, the RSI, is to show you that, yes, by moving up and then trading sideways, we help relieve the overbought condition. So we're getting a little bit overbought again. The main thing is, however, that the market broke through a very significant resistance area. And based on our change of polarity, what that means is the prior resistance shown by these blue lines here, around 1375, should become support on any retracements. And I wouldn't be surprised in seeing a retracement considering how far the market has rallied over the last week or so. But my outlook would be if it holds above 1375, give or take a couple of points, we're fine. If it closes much under 1375, then the risk is down to the lows over here. We can see how there was an important support area based on a multi-tested support right around 1330, 1340. But the reason this breakout was so significant, made on Monday, and I'm going to show you the weekly chart now, is it broke above a long-term major resistance area. Here we have a dark cloud cover. Here we have a bearish engulfing pattern. And once again, for those who are fairly new to candles, remember on our website, candlecharts.com, we do have a free basic candlestick glossary detailing all these patterns. Another bearish engulfing pattern over here. So anywhere from the 1360 to 1370 area, based on weekly chart, with strong resistance. And you can see how the market pushed above it over the past couple of weeks, but never closed above it. So that means if on this Friday, because this is a weekly chart, and we do need the end of the week to finish the candlestick signal for a weekly chart, any close above 1375 would give that extra confirmation for a bullish breakout. Here we have a hanging man line. It's one of my I shouldn't say it is kind of less important, but the hanging man line, I don't have time really to get into it, really needs some bullish confirmation, some bearish confirmation. The hanging man line theoretically is a potential reversal, top reversal signal, but we need bearish confirmation for the hanging man line. And we could see the importance of waiting for bearish confirmation. Bearish confirmation would be a close under the real body. And obviously, as of yet, this is done on Thursday at about 2 o'clock Eastern Time. We have not had that bearish confirmation. Now, what's interesting on this weekly chart, some of you may recognize this pattern. Left shoulder, big head, and right shoulder. This is an inverted head and shoulders. And what happens is you go from the low of the move, which was about 1075, to the neckline, and that's about 1275, 1300 in that area. So you take that distance. So whatever that is, what is that? About 220. Actually, the neckline here. So we go from here to about over here. So it's about 1300 to 1075. So that's 225. You add 225 to the breakout area of 1250, and we get a target, an upside target of 1475. Now, remember, an upside target does not mean it's a resistance area. But what we here at candlecharts.com like doing is getting a target and then seeing if we get any bearish candlestick signals at that projected target. So as of now, our near-term target is 1475 based on the head and shoulders. And above that, we have to go to a monthly chart to get resistance above 1475. And we could see a little dark cloud cover over here, an evening star over here, a bearish engulfing pattern. So the next major resistance is up at around 1575. And although we have a target of whatever I said, 1475, whatever the number I gave before, I forgot, it doesn't make it a major resistance area. It gives it a projected target based on the inverted head and shoulders. But when we have a multi-tested resistance area, as we do on this monthly chart, that to me becomes a much more substantial resistance area. And finally, on the crude oil chart, just an update. Last time I did one of these on crude oil, we were talking about this rising window as support, and I think I did it a few weeks ago, and notice how nicely this rising window has held as support in the nearby crude. And we talked about this being a breakaway gap because it gaps. In other words, it has a rising window, but it also is a clean-cut break above a resistance area, confirming a break that we had in this tall white candle. So we have two reasons for support around 104. We have that rising window, and we have change of polarity from the old resistance around 103.5 to 103. I initially had a target around 115. Those are the highs we made back in April of 2011. But it looks like we have a bearish, and this is what we mean by adapting to the market, one of our trade management principles. We have about 12 trade management principles, and one of them is being a market chameleon, adapting to the market. So we can see how this bearish engulfing pattern 110 set up our first resistance at the 110 area. Notice how although the market got above it over here, it failed at that resistance area, give or take $1 or so. So our near-term resistance area is up at 110 to about 111. Then above that would be the major highs made last year at around 114, 115. Something to keep in mind, although this rising window and the change of polarity is holding very, very well. We have a bullish shadow here. This is not a hammer, by the way. We have a piercing pattern here. What I see is that we are making lower highs, so it looks like supply is coming in at lower price levels, so that does keep some downward pressure on the market. But the major support at the rising window to the change of polarity, and if we get much under 103, I think that could be a major break to what essentially is a longer-term bull market. But right now in a trading range, I'd say 110, 111 to around 105 to 103.5. So thanks for joining us, and may the candles continue lighting your path to greater prosperity.